most people don't realize how good a run it has had in the last 20, 25 years. So the returns, very solid, that's true. They're also less volatile. In farmland, especially if you're building a somewhat diversified portfolio, you can expect high single digits, maybe low double digits.
One thing I noticed when I was doing some research is that you grew up in the Soviet Union and at a time and place where food was not abundant, as it might have been at least in the US, especially today. According to Maslow's hierarchy of needs, food, shelter, and clothing are the basic necessities for survival. And you'll notice that food comes first, right? So, what was it like to not have basic staples easily available? And what impact did that have on you at an early age?
It's a good question. And as a kid, you kind of don't know what else is out there. So you sort of get used to it. It's really then seeing the contrast of what can actually be that I think had that profound effect. So around 91, 92, when Soviet Union fell, Russia opened up, and so you had an influx of goods. And then you sort of saw the difference of you had nothing, then suddenly the shelves were just brimming with so many different options. Story sometimes like to tell. I remember when I was like 6, 7, I was standing in line for like bananas for 2 hours because they had bananas this month. Whereas now, you suddenly just go anywhere and you be like, I don't care. I mean, there's bananas everywhere. It's just such a easy thing to get, and so it's just crazy to think that it was all just due to different food systems and economic systems.
Do you think that stuck with you later on when you are becoming more and more interested around agriculture? And you've been into some ventures that are kind of based around the idea of getting food out to people. Do you think that kind of comes from these early beginnings?
Yeah, absolutely. I think the fundamental nature of food and land as it is connected to food is something that I'm really drawn to, especially the longer I live, because you get these different waves and fads coming in and going, and we always feel like we are inventing something new, and then this time it's different. But sometimes it is different, most of the times it isn't. And so I think it's just been really nice in my professional career with FarmTogether to build it on something that is so fundamental to who we are as humans, right? We need to eat food. We have this habit. So yeah, absolutely.
While that sounds like humble beginnings, you've gone on to have this incredible career and got your MBA and went to go work at one of the most prestigious and famous pension funds in Canada. Was that experience one of those where you were honing your craft of investing, and did you just pick up some tips and tricks along the way? Did it have a material impact on you as an investor early on?
Oh, absolutely. I would say Ontario Teachers is probably one of the best investment organizations out there. They've been around for many, many years. Their returns are absolutely stellar, especially given the size. They're over $200 billion or approaching that number. And so the way they think and work is so systematic, because investing is just can be so emotional, so volatile. So it's, how do you consistently generate alpha and generate good risk-adjusted returns for the pensioners, the retired teachers of the province of Ontario of Canada. And it requires a lot of skill, a lot of work. And so I was very fortunate to be in that organization for a few years and to soak it in from many different great investors and people I was fortunate to call mentors, friends, colleagues.
You actually got your career started off as an investor and then went to become an entrepreneur, which is always kind of interesting, right? Because I don't know, I feel like a lot of investors look at entrepreneurship like it's kind of easy or something. Maybe, I don't know, because maybe not, but I feel like, when you're sitting on one side of the table, you're like, well, why aren't you doing all these things? And, as an entrepreneur, you're like, because I'm doing 100 other things.
That's
so,
right.
so when you flipped the script a little bit and went in to be more of your own venture, what were the learnings of like that? Or what were some realizations you had maybe early on or as you went along?
Yeah, well, first of all, definitely entrepreneurship is the hardest um, one of the hardest things you can do. Let's put it this way. And I was also that kind of investor where I was looking from outside in, going, "Well, that's so easy. Why don't you do this? Well, you should just go this. Isn't it obvious?" And then you start doing it. So yeah, it was definitely a big shift, but I was able. I think for me, what was really fortunate is that our business is an investment business. So I was able to still use a lot of my skills to kind of make the transition to entrepreneurship a little bit easier.
One of your kind of first entrepreneurial efforts, it appears to me, was from Full Harvest, which is a really interesting business actually, because it's connecting businesses with farms in this effort to use imperfect produce, which is becoming a little bit more well known these days. That whole concept, right? Just things that don't look good on a shelf but are still useful, and they would otherwise go to waste. And I find that model so interesting, both economically and socially. What were some of the challenges involved in a business like that, and maybe some learnings that you then took on to FarmTogether?
Yeah, absolutely. So I joined Full Harvest as its first employee, CFO, and operations guy, kind of right-hand man to the founder in 2016. And it was just her, and then me, and then a few other people. I mean, the challenges are many. When you're trying to fix such huge problems as food waste, which is a huge problem. We waste a third of our food, and if we wasted just a quarter less, we could actually feed all the hungry people. So I just keep coming back, to a major, sort of like a bigger philosophical point that we do live in a world of abundance. And it is the systems and us as people that make things scarce. Like there's more than enough on this, God-given earth for everyone. So Full Harvest is near and dear to me, and the company is, doing incredibly well. And just for the listeners, so the business is really take the imperfect produce that farms always have, because guess what? Nature doesn't produce, celery hearts in plastic bags of 3. So you have to make them shelf ready. And while you do that, a lot of food gets wasted. And so Full Harvest would connect the farms directly to buyers that don't necessarily care if the food is picture perfect. Juice companies, for example, that process them. And found out it's a massive business. It was a three-sided marketplace, logistics, buyers and sellers. And through that experience, well, one, I was just able to see much more the farmer side of things, because before that, I was looking more at the investor side. So I was able to meet a lot of great farmers, go see farms, and also understand the challenges that go into building kind of two, three-sided marketplaces. Because FarmTogether, in a way, is a marketplace between investors and landowners, farmers. So marketplaces are notoriously hard. They are something that are very hard to stand up. But once you do, then they're also equally hard to displace. Because once the marketplace gets going, the flywheel gets going. And so, yeah, the opportunities in the food system is absolutely massive, because they're not that sexy, right? Not a lot of people look at them. And so my investor hat is I want to look where no one's looking, because everyone is looking at Apple stock, at crypto. So that ship has sailed. Whereas in food, like, I mean, Trey, if you ask 5 people and be like, what do you know about food investing, farmland investing? No one will be able to tell you. So and yet it is so vital, right, to our lives. It's health, it is nutrition, it is food security, as we're learning right now from the conflict in Russia, Ukraine. So there's a lot that is connected with food, and Full Harvest really opened up my eyes to everything else beyond just kind of the investment thesis that I had around farmland.
Well, you're thinking kind of like I would say Bill Gates and maybe even Warren Buffett are thinking, right? With buying up so much farmland. Bill Gates, by proxy through his foundation, is the largest single landowner, I think, in the country, which we should talk about a little bit.
Yeah.
But I'm kind of curious, this moat you kind of mentioned, this defensibility, let's call it. It seems to kind of play into the thesis here, as well as the performance, which I also want to kind of cover. From what I've seen, and you can correct me with maybe more recent data, but Farmland has been posting an annual return of around 11.2% for a 25-year period that ended in March 21. And that was compared to a 9.6% gain for the S&P 500 during the same time. So it's also worth noting that the S&P 500's return is much more volatile. So I think it was actually twice as much as farmland. So you mix together the Sharpe ratio there, the yield, and the defensibility, and I'm like, well, this is classic Buffett, classic Gates, right? So is that kind of the thesis here? Or are there other things that play into it?
That's absolutely part of the thesis. Farmland, I think most people don't realize how good a run it has had in the last 20, 25 years. So the returns are very solid, that's true. They're also less volatile. In farmland, especially if you're building a somewhat diversified portfolio, you can expect sort of high single digits, maybe low double digits, but you're not, investing for 10x return. That's not going to happen. But when we think about investing and when we think about sort of how people go about meeting their goals, there's other things that farmland provides as an investment product. Because remember, no one invests for like the sake of investing. Everyone invests to meet a certain financial, personal, or organizational goal they have. Pay pensions, save for retirement, save for college. It's not like, but I want more money. Although that's, that is the basic idea. And so with farmland, you also have something that is extremely pertinent these days. It is a fantastic hedge against inflation, at least it has been historically. So during periods of high inflation, farmland has performed very well, done better than gold equities. And that's because by its very nature, farmland is something that is inherently very hard to create. In fact, we're losing farmland. We'll talk a bit about that. And it's super basic. So when you think about inflation, it's really, well, there's now more paper to buy the same amount of goods. Well, farmland's not magically going to double, triple, and so it just has to move with inflation. Also, hundreds of farmland products actually go into the CPI. That's what we call food, fuel, fiber, feed. Right? It's not just cereal; it's a lot of other things that farms produce. So that's a major factor. Seems like after inflation, we're going into recession. Well, guess what? Actually, farming has done quite well in periods of recession too. In 2007-8, it was up 20+% when everything was down 50%. In the latest blippish crisis we had, the fastest crisis I've ever seen. Well, most people think I've ever seen COVID, Q1, when everything was down majorly. Farmland was also fairly flat. And during the tech boom of 2000, 2001, farmland was up when everything's down. So that's another big factor. And then the last one I want to mention for your listeners and just in general, there's a big ESG component here. So when we talk about sustainability, regenerative agriculture, water scarcity, as well as now more and more farmland actually becomes this optionality play with solar and wind. There's a lot of things that come into play where you go from being like a farmer that wants to just extract the max amount possible of yield, which by the way, nothing is wrong with that, right? People have to eat, to someone that is more like a steward of land, where you have this additional responsibilities around carbon, around being good to the local ecosystem, as well as the local communities. So it's really, when we talk about land, the reason it's so fascinating is because it's like so central just to our existence.
Is that performance mixed with the volatility a result of illiquidity? And in this instance, is illiquidity sort of more of a feature than a bug?
Partially, yes. So there are two publicly traded farmland stocks, Farmland Partners and Blackstone. And indeed, we see their stock be much more volatile versus the underlying asset and the farmland index, and even what we see, in our work. So it's a feature because it's more liquid, indeed, and it's also a bug in the sense that, and it's a buggy feature, if you will, because you have the stock not represented times the underlying asset, and so you are able to enter into the underlying asset at an attractive price if the markets are being too panicky, but you also sometimes don't have that ability. You can sell that stock when the price has run up too far. So just look, I think in general, every asset will become more and more liquid because liquid is just us being able to trade in something. I see nothing wrong with that, right? I think more and more assets should be liquid. So as that happens, farm will absolutely become more volatile. But Trey, if I can use this as a jumping point to talk about volatility as a proxy for risk, because when we talk volatility, we kind of think risk, and I think it's funny because investing is very common sense. When you and I think about risk, I think like, how much money am I going to lose? Or did I get more than I put in? And then you get this Chicago PhDs and this brainy scientists, and I know I was one of them, and they will have this insane models on computer, and they'll say the same thing, which is basically, am I going to lose money? So Farmland, I think, why it's less risky is because not because of like volatility, this, that, but because risk is a function of uncertainty. All right. When you invest in something like to what extent is this uncertain? So volatility is really that uncertainty. And with land, there's been only 2 quarters when the index actually lost money. And when you think about it, like you invest in a corn farm in Illinois. I mean, you fly over Illinois, it's just farms, farm, farms. So there's, first of all, thousands of them. You have really good sense of your price. Um, it is unlikely that that farm will lose its inherent asset value because that means that people stopped eating, I don't know, corn and soy, and there's suddenly like fewer people and more land. That's just not a reasonable base case. So when we talk about farmland being less risky, it's that the inherent value and ability to maintain that value long term is very, very clear. We've been farming for thousands of years, probably will farm, I don't know, until we'll go to Mars or something or virtual. We're going to keep farming. And so to me, when you're investing in like some crazy crypto coin, like I have no idea what it's going to be, right? In farmland, you know exactly what it is, exactly what it's going to be. So anyway, that was you got me very philosophical here, but
I love it. I appreciate that. Before we move on from Bill Gates, and I mentioned he's the largest farmland owner. He's invested over $100 million. I think last time I checked, it was something like 200,000 acres. Something you'll know better than I do, I'm sure. But give the audience a little bit of an idea of what the total addressable market, though, of farmland is in the U.S. and how it compares to what Bill Gates owns, and give them a sense of the market here.
well, look, first of all, I want to give a shout out to not even Bill Gates, but to whoever outed him out, because in the farmland investing space, it's been a well-known secret that Bill Gates is the largest farmland owner. And then somehow it just became public and everyone knows this. Like it's really been incredible in terms of generating interest, that one fact. But Bill Gates, I think, owns something north of 200,000 acres, I believe like 230, 40,000, which sounds like a lot, and it is in the billions, not in the millions. But let me just paint a picture how tiny it is. US has 900 million acres of farmland. So that 240,000 is like 0.0, and then it really is a rounding error. So the market is absolutely huge, and that is broken down between what's called pasture land. That's where you graze your livestock, and cropland, where you grow crops.
Yeah, let's talk about that. What are the different types of farmland and which ones are the most optimal in terms of margin or ease of operation, a number of other factors I'm sure that play into it?
Yeah. So those are the two major types, the pasture land and the cropland. Now, within cropland, you have um, permanent crops. So this is crops that are permanent. So your trees, your apples, your citruses. And then you have what's called row crops or annual crops that you have to plant every year. So corn, soybeans. Um, it's hard to say like which one is better because it seems like which food is better. Well, they all play a different role. But broadly speaking, in the raw crops, you have low risk, low return investment product that typically, we target anywhere from 6 to 7, 8 total return net of fees. And that is something that is fairly stable, unlikely to lose money in the long term, unlikely to make a lot of money in the long term. We had investors compare row crops to a mix of like gold with a coupon or sort of investment grade bonds, sometimes compare that to timber or real estate or like inflation linked bonds, because typically the rent and the land prices tend to move when inflation moves.
I asked because I was researching here and it appears that apiculture, which I had never heard that term before, but it's essentially beekeeping, is one of the higher margin businesses. I think just because of the scarcity of it and the
Oh
honey
yeah.
market, which I haven't looked into. And the margin thing is interesting to me because you see how Michael Burry went on to do a number of things after the GFC, but one of them
Mhm.
was investing, I believe, in almond farms
In water farm, in
in
water, yeah.
water farms. Okay, because California, for example, there's a lot of almond trees, almond farms,
Mhm.
but you also hear that California doesn't get a lot of water and almonds need a lot of water. So to me, I would just think subconsciously that that's a low margin business. Why get involved
Mhm.
there? So what are some aspects around commodities and margin and where you should kind of focus the most of your energy when you're an investor?
Yeah, and I think Michael Burry, I mean, obviously I haven't seen his portfolio, but he should have done quite well with his portfolio since the great financial crisis. Um, so the highest margin farms would be your tree nut farms and your fruit farms, namely like apples, cherries, and organic, of course. Um, but that is because, again, you have more risk and more volatility. So let me use almonds maybe and apples as an example. So in almonds, you have indeed more volatility in water. You have a fairly, like as we've seen the last few years, the markets can be quite volatile for the almonds themselves because it's an export product. California grows most of the world's almonds, and so because of that, you get higher returns. But it's a very mechanized type of farm, so you can do a lot with a few people. And there's continuously gained efficiencies in genetics, in how you plant trees. So, you talk about the bees, some of the more recent almond varieties are self-pollinating, meaning that you're not as reliant on bees. And with apples, you also have this interesting situation where you have different varieties coming out all the time. And if you can get on that variety and ride the train, then you actually can get some amazing margins. One of the farms we have, I mean, it's projecting margins in some years as high as 40%. So it's not going to be forever, but a few years where you get incredible returns. And then it's also, it's not just the margins themselves, right? At the point of time, we're all lazy. We just want to invest and forget. So is it going to deliver those margins consistently over many years? And yes, once you plant the trees and they get going and everything is set up, it is a money making machine. Some trees like pistachios last for like we don't even know how long, 40, 50 years, right? So you have this plant a tree and then for generations, your portfolio and your kids will do well from having that investment.
150 years ago, almost 70% of people were working on farms. And by 2020, it's gone down to 1.4%. So clearly a sign of technological advancements and higher standard of living, I imagine. But in contrast, the ownership of land, which still consists of individual owners, has hardly changed. So I actually find some solace in that, to be quite honest with you. I like the fact that individuals own farms. To me, it just kind of, I don't know, I signify higher quality for whatever reason. Juxtaposed to maybe Monsanto owning all the farmland in the US or, is some corporation. I find it interesting, but what does that do to the supply side? If there's all these individuals, is there less selling going on, which is then kind of upping the value of this land?
So there's actually more selling going on because a lot of the farm owners in US approaching 60. A lot of them are in the 70s, 80s, and as they retire, kids don't want to farm. So you get this consolidation and turnover of farms because as you kind of move land through generations, first of all, you just get more and more heirs, and then you get into, I don't know if some of you listeners who've seen Succession, you get the same fighting for who gets to keep the farm and what to do with it between a lot of different people, and it can be a mess and a lot of fun as well. So now there's more turnover happening because of that kind of transitioning in how we live, how we the rural and urban divide and split. So the estimate is that about 70% or more of land in the US will change hands in the next 20 years.
Going back to California needing a lot of water and that being an issue with droughts and everything climate related. I mean, you're in Portland. There's a lot of farmland up there, but it was the hottest year on record recently, or hottest area of the U.S. at one point in the recent past. How much do the climate related factors play into your investing thesis when you're assessing a farmland?
Yeah, I mean, you have to think about climate when assessing farmland. And so you look on kind of at high level where we will model additional um, water needs and water evaporating because of hotter surface. We look at things like chill hours, where almonds, they require a certain number of cool weather, but not too cool. That's why California is so unique. It's a very specific climate. And so that changes, you have to move up further up north. You have things like historical things happening. Colorado River, I think, for the first time had to curtail its water allocations kind of down the river, which I don't believe ever happened. So it's just, I mean, Trey, it's such a huge question that hard to answer it, give it proper time here. But in short, absolutely, we pay attention to it, and it's a lot of fun. It's very interesting, and it's very specific to different regions and crops. And there's opportunities and challenges there.
You mentioned Succession. There's another show called Yellowstone, which I've been saying is like the Succession and just put in Montana, right? And the idea is there's this farm being passed down by generations and they don't want to give it up, but there's all these people trying to make developments on it and take it away from them. So I imagine that's a very real problem. And I read that over the last 20 years, more than 11 million acres of US farmland were also lost to development. So is there a certain rate of decline or I guess rate of supply happening that's also a factor here?
Yeah. So and I think it's even accelerating, if I'm not mistaken, because if you look in the last 5 years, I think oh gosh, was it like 4 or 5 million acres? Now there's still a lot of land, but yeah, it's urban development, it's climate change, it's kids not wanting to farm as much. All of those factors come into play. It's also on the flip side, we do have increasing efficiency of land we use. So we are getting better and better there, and that plays a role.
I was kind of curious about that. I mean, you hear a lot about soil degradation. I know there's some technologies around getting more nitrogen into the soil. There seems to be efforts in science and investment going into how to get more yield out of farmland. But to your point, it's hard to reproduce farmland. What about things like, Kimball Musk, Elon's brothers, investing in square roots where they're creating containers and growing crops in containers that could just stack up high in New York City, for example? Is this a real risk, in your opinion, at this point? Is it too far into the future? Would it help in any way? Would it disrupt in any way? Any general thoughts on that?
Yeah, look, I get this asked a lot and more broadly about, vertical agriculture. And I think it has its place for certain uses, for example, for leafy greens, for herbs, where it's a high value product with a small footprint, or where you need to be near a big city where the freshness of it and the transportation costs can be, take a toll versus being able to go somewhere right in Manhattan and get your lettuce growing on the Empire State Building. I don't know. So there's definitely some benefit there, but it only plays a role at margins, because at the end of the day, I always like to come back to fundamentals. So when you talk about farmland, you're talking really about free water that falls from the sky, because a lot of farms in the US are actually rain irrigated. Free energy coming from the sun versus having to put the right input, like the right light in place. Increasingly with regenerative agriculture, it's also the vibrancy of the soil, and the additional benefits that you're giving back to the ecosystem, and just like economies of scale, being able to drive that tractor through huge field and make it much cheaper. So it's just physically hard. We're talking about Elon Musk and or the Musks, and thinking about first principles. There's just too much from basic physics that I don't think will, in the near term at least, make that sort of container growth or vertical farming a threat to the more sort of land-based farming.
Yeah, I know. I think people like to kind of shorthand think about that stuff where it's like, oh, this is just going to take over. But when you go back to your point about there being 900 million acres of farmland. That's quite a feat, to disrupt.
Yeah.
So going back to Buffett here, he's frequently used farmland to illustrate a simple business. And he even refers to the different business silos at Berkshire Hathaway as his orchards. Are farms really as simple as Buffett would suggest as a business, or is it more complicated than we think?
It's a great question, and yes and no. So on the one hand, for us, for FarmTogether, one of our investment products is a row crop farm where we buy it, we rent it out to someone, they pay us a fixed fee. And by the way, it's very common. So 40% of land in the US is rented, and mostly it is between individuals. And then we maybe get sort of a function of a crop revenue share or price appreciation share. So it's very, very simple for us. We pay, I think, like only a few payments a year. We get our check. We know the farmers, typically they're multi-generation. And so it's that simple for us. Now, for them, it's probably quite complicated, right? And then when you go into permanent crops where you have trees and you have to take care of the trees and you have to water them right, you have to make sure that you have the right pest control protocol in place. I don't know, like I wouldn't say it's as difficult as any other business. And a lot of other businesses, weather doesn't play a role. Whereas here it'll be like, oh, I want to do something today. Well, like, no, you have to actually go to the farm and switch on the sprinklers and cover the trees because we have unusually cold weather, things like that. So there's more and more technology coming in that is making things easier to predict, to manage. And so I think farms will definitely get simpler, but yeah, I don't know if I would go as far as to say that it's a simple business.
Well, similar to Buffett, who typically likes to stick to the US when he's investing, you often focus on US only farmland US. And only US. But some of the best produce comes from Europe and say Italy or volcanic regions, South America even. Why just stick to the US?
Well, this is where we start thinking about farmland as an investment product. And so when we think about it that way, we use the real estate lens quite a bit and the analogy of real estate. And by the way, farmland, if you think of it as real estate, is the third largest real estate market. So we have single family housing in US, which is tens of trillions. It just dwarfs everything else in the world. You have multifamily housing, about 3 trillion, and then farmland, also 3 trillion. So it's a huge real estate market. So the reason for that is, and when you invest in real estate, it means you cannot move it. So you're the total mercy of the country, of its laws, of its infrastructure, its labor, and US is just absolutely a beast in that regard. Despite what the issues were with infrastructure, it's still a killer infrastructure with great ports and railroads. Coming back to Buffett also likes railroads. And we have Mississippi River is just a wonder. The transportation is so cheap. I mean, it's in ways responsible for like US is what it is today. You have extremely productive workforce and farmers that are very innovative. You have the rule of law, right? No one can take that farm away. So that's super important because yes, Latin America, you're absolutely right. A lot of great countries there, great farms. Do we feel as safe about the laws and regulations there long term? Because this is a long-term investment. We do not. The only other country that I think, like two countries that we're looking at in terms of that think give similar level of safety is Canada and Australia, because we're talking about this is a safe investment, safer, call it investment product. Nothing is safe, it's an investment, right? But farmland is on that low risk, low return spectrum. And so we want to play it as such. We don't want to make it Bitcoin. We want to make it the boring thing you invest and forget. The US is the best for that.
Speaking of Bitcoin, it reminds me of gold. I saw this chart today actually showing that commodities have outpaced gold in this high inflation environment by double, right? So I just found that so surprising. That's more about gold, I think, than anything else, but it shows you how farmland can keep up a lot, I imagine, with inflation just because of the increase in pricing of the commodities it's producing. But sticking with Buffett there for a minute, he likes to buy and hold forever, typically. what is the typical duration when you're investing in farmland? Is it buy and hold, or when you're investing, let's just say in a product offered by FarmTogether, are there end dates to those investments?
Yes, we would like to hold forever as well. And actually, we do have a fund that is an open-ended fund where we want to hold the land forever. But most of our deals are 10-year hold, and that's just a compromise between finding the right sort of level for our investors. But yeah, farmland is absolutely a great investment. So in fact, my alma mater, Ontario Teachers Pension Plan, has quite a sizable farmland portfolio now because they have to think in decades, right? The duration is 70 years plus, where they think about the time horizon.
That raises an interesting question about FarmTogether and the cohorts involved using the platform. It seems like it's a great resource for everybody, including pension funds. But when I'm a retail investor and I'm going on this platform to buy some farmland, am I going up against pension funds and the like who are outbidding, sweeping
No.
up these products? And yeah, well, how can I compete there?
You only compete with pension funds when you're buying really large properties. And that is the beauty of farmland market or FarmTogether as well. So you mentioned that most land is owned by individuals. So indeed, 98% of all land in the US by acreage, by number of farms is owned by families. The market is very fragmented. Most farms are in less than $10 million in value, less than a few hundred acres. So what it means is that for large buyers like pension funds, it is very hard to build anything that moves the needle for them. That's why we haven't seen actually a lot of those players in the space yet, because they will figure it out because the asset class is just that good. So for now, what I like about this is that in a way, we're like front running the institutional market is coming in already in the space and will come, where I think the whole farmland market actually in the US will reprice to this diversified portfolio level, whereas right now it's detached to the broader capital markets, which I think will benefit actually the farmers and landowners, because it's really important, coming back to risk, volatility, uncertainty, to price assets correctly. That don't want to get into economic theory, but it really helps everyone when your assets are priced well, fairly, transparently.
Well, let's talk a little bit about that theory where I've heard you say that you can build a quote unquote pleasantly boring portfolio using farmland. But given that it's low risk, low return, as you put it, where does it fit in a portfolio typically? Is it sort of like in that all weather sense where you've got that 5% allocation to gold for the same reason? Are you kind of thinking about that, or is it taking up, given that it is such a great asset class, as you put it, is it something that should be considered almost like an allocation you would put towards stocks?
It's a great question. So portfolio construction in general is an evolving science, where before we used to have this, I'm sure all you listeners know, 60-40 portfolio stocks and bonds. And then at some point we started adding real estate, and we used to be like, oh, that's so exotic and risky. You have real estate in your portfolio. And now it's like everything, right? The emergence of alternative investing, alts going mainstream. It's when you stop. I like to tell this joke is that the difference between um, like if alternative medicine worked, it just would be called medicine. So the the alternative investments one day will just be called investments. So I would say, to answer your question, where farmland belongs in you, I cannot give investment advice. So I'll just muse a little bit on that. There's elements of inflation-linked bonds in farmland. There are elements of real estate. There are elements of timber, elements of gold as well. And so Nuveen, kind of the granddaddy of farmland investing, did a research essentially modeling farmland performance against historical stock bond portfolio, and measuring that Sharpe ratio, that performance, and that portfolio with farmland added did better than without farmland. And they, I believe, were using something like 5-10% in their allocation. And we have this information on our website, so people can take a look. But I mean, yeah, I cannot really give investment advice on how much you should put, because it's so dependent on individuals. But I hope what I said can kind of help a listener think through their portfolio,
Absolutely.
make a decision.
That comparison to real estate is super interesting. And with real estate, especially lately, the issue is that the prices are rising so fast, and it's bringing those yields down. So in a high inflationary environment like that, let's say for real estate, are we seeing the same thing with farmland? Are the yields kind of coming down because the price of the land is going up so much?
Yeah, yes.
What's the context of that? Are we at historic lows on yield versus farmland, or how does it kind of compare to the past?
Right now, we're definitely, I would say, at the sort of on the lower range of yields. Um, a lot of what we see is like 2%, 1.5%. And so with that's definitely kind of on the lower side. Um, the yields have been going down quite a bit. So I think what we'll see is either all asset classes will kind of correct, um, or kind of stay there, but for a prolonged period of time. Um,
Yeah.
but look, it's hard to predict the cycles. The thing to mention about farmland is that you have two counter forces. You have the inflation that's pushing farm prices up, but then you have the interest rates going up, which any long duration asset is going to fall on farmland. You can think of it as a long duration bond, so it's more sensitive to interest rates. So it's kind of, it'll be interesting. It's actually, we haven't had this in 40 years. Like the economist in me, because I have a master's in economics, kind of more academic, is fascinated to see like what's going to happen with this inflation, with interest rates. Like it's a fascinating time.
That was my next question exactly, is that the interest rates rising, is what's that going to do? Is there an opportunity there? Once you own the farmland, what's the future of this look like? Are there going to be derivatives based off of this kind of thing, of these products? Are there secondary
Yeah.
markets coming? What's the future
Oh,
of this look like?
absolutely. Yeah, absolutely. We like to say that farmland is 20 years behind real estate. And if you look at this cornucopia of real estate products and offerings, I mean, you can sell, you'll like this day, you'll be like, I'm selling a quarter share of my shower online. Like everything is so fractionalized, financialized. And so farmland is moving in that direction in the sense that you will have a secondary market, you will have additional financial products. Um, I'm like we're working on some stuff right there. It's sad to see that farmers have so few options to finance their business and think about their business from transitioning to organic, expanding, succession planning. And there's nothing really out there in terms of financial products that real estate has. And so there's just a lot still missing there.
Going back to those individual owners and how few of them there are, it also is reminding me of the labor market. I mean, how many people are wanting to work on these farms? Because if you don't have workers, it's hard to have a farm, right? So is that a risk in your opinion? Are we seeing a decline in the interest of farmland work?
Yeah, absolutely risk. And that's why we need, I think, better laws and more streamlined ways to bring in seasonal workers to US. Although it's working pretty good as is, but that's a big one. And then automation, mechanization of farms, that's helping alleviate some of those issues. Um, but also, look, I think the farmers we work with, they enjoy the lifestyle. They actually make quite good money, and they get to spend their time outdoors having fun. They'll have dogs, they'll fish, they hunt. I mean, whenever we go see them, you kind of like want to stop staring at the screen and get out there. So there's a lot that farming can offer.
When you talked about that, that was reminding me of the state by state nature of the US, let's say. So, for example, when you're looking at farmland, are any states more amenable, more welcoming to, are there more subsidies involved? Are there any particular benefits to one state over another when it comes to investing in farmland?
In short, yes, but if you ask me to be more specific, we'd have to spend an hour just on that. I will say that in California, of course, you have I would say, it does feel that it's less friendly to farming than it used to be, and I think sometimes for wrong reasons and misinformation. Um, of course, like Midwest states, Illinois is a great farming state. One that I want to give a shout out to is Oregon. So it's a great state for hazelnuts. Great water, great workforce close to transportation, um, and to the coast. So that's a really great state. And Washington as well. As climate change happens, you have the Columbia River, which is just abundant water for anything you want to do. And really, the weather is starting to become more and more amenable to more crops and longer growing seasons.
So when I go onto the FarmTogether website and I'm looking around the platform and a deal is offered, what else would I be assessing there to know if this is a one of the better deals that's coming on the platform versus something else? And what would be a bad deal other than just, a very low yield?
Yeah, well, we don't put bad deals on our platform. So we really break it down into risk return spectrum. So we show that classification, and we walk you through how we think about risk. Where does it fall on the risk reward kind of spectrum we have? And so it is really, while we do offer individual deals, that's just the way it's working right now. In the future, we'll have diversified portfolios. But the idea is that you would build a portfolio of many farms where you would have the low yield farms, high yield farms. You'll have your apples, you'll have your almonds, pistachios, so that you have that broad exposure to farmland. But then you can also play around with hey, maybe you want the highest risk stuff only, right? You're young, you're risky, like 7% return doesn't sound too good to you, even though it's low risk. So we have all kinds of investors, but most investors invest in more than one farm.
Are there any commodities to avoid? Like, for example, I grew up in Indiana where it just seemed like the entire state was cornfields. And that's good because, there's a lot of supply. Corn seems to go into almost everything or a lot of things, right? The sucrose, especially. But does that bring the price down, right? Just because there's so much supply of it and so many people are doing it, would that be a commodity that you want to maybe shy away from and focus more on something like hazelnuts or, that's a little bit more optimal?
So we own, let's see. So we don't touch cannabis, just because of regulations. We don't touch dairy right now because there's so many headwinds and it's in a way not even land. And then within the crops, there's certain varieties of apples that are kind of going out of business, but I can't really tell you which ones those are top of my head. The thing is, like, not really. It's you have this fundamental issue of growing population, improving diets where everyone wants to eat like we do in US, and that is a huge lift, by the way. And then you have decreasing supply of farmland. So there might be specific varieties, maybe geographies that are kind of on the going down. But yeah, overall, I can't even think of something where it's like, oh no, don't touch that, because it's all food that we've been eating for thousands of years.
Well, as you mentioned, you don't put a bad deal on the platform. I'm curious how many deals you're looking at and the ratio as to how many you're vetting versus how many actually get put on the platform.
Hundreds and hundreds versus one. It's really, we look at so many. We have an internal AI engine. AI is still a bit of a aspirational term, but like a fairly sophisticated tech system that allows us to continuously, proactively, as well as inbound, analyze, source a lot of farms, so we have a good sense of the market and do a rapid underwriting process that allows us to move much quicker or smarter on a particular opportunity. So yeah, it's hundreds. It's yeah.
You mentioned everything's going to become financialized over time, and real estate, obviously you can find REITs for portfolios on real estate. I'm curious about farmland. Are there any ETFs that are just bunches of farmland put together?
There's just two REITs, FPI and Gladstone, Picker Land and FPI. That's the only two, I think. Yeah.
And what's the benefit or trade-off between just owning an ETF of a bunch of farmland or going into one of these deals? Is it just that kind of diversification and even less volatility, or what are some other factors playing there?
Well, there's a number of factors. So one is you have no say on the properties in the portfolio. You need to really be very certain that the price that you buy in the stock is not too high, because we just talked about, how they can run up too quickly. You have no say over leverage. And so, we talk about farmland being kind of safe and stable. Well, there's one major way you could lose your money if you take on too much debt. And so, what's the leverage on those farms? Um, as well as just seeing how much, like, the ability to add more farms to the asset base and being able to add, good farms there. Um, so you kind of, I think, because of that diversification and liquidity, we feel at least that we can offer potentially a more custom solution for you, where you're able to kind of choose and pick different farms. There's also some other things. This is where I have to give the obligatory, I'm not a tax attorney, consult your own tax attorney, but um, the farms, because it's a pass-through vehicle and LLC that issues a K1, you're able to offset losses in the early years that happen when you do development. You should be able to offset them against your passive income on K1s. You get that additional benefit. It can be quite substantial, right? People pay up to 50% marginal tax rate that you don't get with the public stocks. And then look, we also, not to be too self-serving, but we'd like to think we're really good at our job, and we keep getting better, and we keep using more and more technology. We're kind of the young and hungry, scrappy company. So you get that passion and drive from us as well. And look, we send also updates from every farm. It's kind of fun. You get some videos, so there's that emotional aspect to it.
That's fantastic. Going to the tax portion, I imagine there's not a lot of depreciation with the farm versus something like even a piece of real estate. What is that a factor at all? Is the soil degrading over time? Are
No,
there different factors around depreciation?
so soil can degrade, absolutely, but land does not depreciate, and IRS even says there's no land depreciation. So if the IRS says it, then we're good. Of course, land can decrease in value and soil can get depleted. There's the kind of agronomical facts. But what I mean by depreciation is the following. When you plant trees, so trees do have, a certain depreciation schedule. You also, when you put up trellis, you drill a well. So there's a bunch of improvements that happen on the land. So it's a fairly favorable treatment of those capex expenses, where a lot of them can get depreciated almost 100% year one. So you can get a very nice, very quick offset for your income when you invest into a farm like that. And so for people being like very smart and sophisticated about the tax planning and strategies, that can be a very meaningful additional bump that public stock just will not provide to you.
So when I'm investing on FarmTogether, is there a minimum maximum going to investments? And is FarmTogether investing alongside with its own vehicle? What does that look like?
Yes, the minimum is typically 15,000. FarmTogether does not invest, but the principals, so the key execs, do put our money in every deal. Look, it's not a lot per deal, but it's a lot to us because we still like to think of us as kind of, well, we are a early stage company, meaning that we're not paying ourselves much. We want to make sure that we deliver the value to investors first, to our shareholders as well. But yeah, we put money into every deal. So I've been enjoying it right now because I get this little coupons from farms I invested in, and it's nice to have passive income, I tell you.
Are farms typically high dividend paying assets?
Yeah, they pay every year.
That's fantastic. And then are you guys fueling these investments with any leverage behind it? What does that typically look like?
We do for some farms, especially development and other farms, really improve returns, add that additional kind of potential tax component, and help us invest in larger farms that we couldn't otherwise. We are using less debt right now just because where the interest rates are, it's still being accretive on a lot of farms. So yeah, we probably you won't see that for a while.
With the secondary market, would I be at any kind of risk of a worse return I mean, it's a secondary market, but my point, I guess, is the volatility there being so low is kind of, we talked about earlier about the illiquidity being a feature. So if things start trading around a lot, discounts and NAV come to mind, things like that. Are you at risk for a worse performance actually if you get too busy with it?
You could, yeah, and like we definitely want to introduce that, the question of timing. So we'll be very kind of careful with it and intentional, and we'll be looking at what other markets exist that have that. But there's a lot of demand for it, and you could lose a bit of that buggy feature, as we said, of farmland being illiquid. It's almost like a psychological thing where you cannot sell. So a lot of losses happen with people. They sell at the bottom, they buy at the top from all the FOMO, or from fear of greed. So the that illiquidity portion, I think, can be nice. Like it's almost not, when not that it's my kind of area I know well, but in casinos you can put yourself on like a no gamble list, right? And so it's a little bit like this, where like this markets, for example, I mean, so many of my friends, they just get so nervous and they go, wait, should I sell? And then it just becomes like you're working for your investment, not your investment is working for you. And here, like, yes, maybe it might be a little down right now. There's nothing you can do. It's locked in for another 8-10 years, and over a long period things will be okay, we believe. So I hear your concerns on the secondary market.
Very interesting. Well, Artem, this is super fascinating. Before I let you go, I definitely want to make sure you have a handoff to our audience where they can learn more about FarmTogether.
Appreciate the time. Waiting for everyone at FarmTogether.com. Was really good to be here, Trey.
Fantastic. Well, I encourage everyone to check this out. I think this is such an amazing asset class, and you're doing such a service here to democratize it a bit more. And I really enjoyed it. I've been very impressed with the platform so far. So thank you so much for coming on the show, and best of luck. And I'm excited to see where this goes.
Thank you, Trey.
To me, I won't invest in a company unless I think that it has a moat or a competitive advantage, some factor that's going to keep its profits protected from the inevitable forces of competition. If a company is out there and they have a hit product of some kind and they're making money,